associate researchers from Quant Club, are going to introduce you to the fundamentals of stock market and trading. Next slide. Today, we'll start off with the need to invest and then talk about some available options for investing today. Then we will move on to a life of a company from its start to its end, where it lists in, from beginning to the listing in the stock market, that is IPO. Then we will move on to stock market charts, where we will, with the help of live data, we will try to understand how to read live charts and the components involved in analyzing it. After that, we will see some different parameters that an order consists, and then we will try to place trades in live market for testing.
All right. Now we have summed up the whole content of today's session. Before getting into the intricacies of stock market, we'll first try to understand the fundamental question: why should we invest in the first place, or why should we consider putting our money and instead of just putting it in a bank account or something. So for that, I have designed this a cool tool which I'm calling the life calculator. We're going to look at it, and through this we are going to crudely do some financial planning for for the upcoming 30 years in our life, right? So before we dive into that, let us first start by understanding a few key points. Assume that you are 30 years of old and 30 years of age and you have a job and you have a monthly salary of, let's say, 50,000, right? And you have an monthly expenditure for your family and your parents, which is, let's say, 30,000. And now this expenditure is increasing day by day because of something called inflation. Inflation is what increases the price of goods and services all over the world. Like, you cannot avoid this, and this happens day by day. It is happening every year. So right now the average rate of inflation in India is around 7.5 to 8%. So what do you understand by this is, roughly you can say that the price of services and goods are increasing at a rate of 8% per annum. This is how you can understand inflation in a very crude manner, right? So we have this rate of inflation. So our expenditures are going to increase day by day, right? Uh, to account for this, most employers, what they do is they increase our salary also. So let's say there is a salary hike, yearly salary hike of 10% or something, right, to combat this inflation. And after spending our money every year, we have some money left with us, which we're going to invest somewhere. Let's say in a fixed deposit bank account or equity stock markets. Or we are also going to look at an example where we are not putting the money into any securities, right? Next, we have this concept of emergency fund. What is an emergency fund? Let's say that in one particular month, your monthly expenditure is more than your monthly salary. This might be because the salary hike is lesser than the inflation rate, so your gradually your expenditure becomes more than your salary, right? So in that case, what do you do is you absorb money from the funds that you have already saved up over the previous all the years, and you take money from there and you then spend it on the current month. This is the concept of emergency fund. And we are going to make another bold assumption that after retirement we are not doing any investments, right? So with these assumptions and these key points in mind, let us look into what the life calculator does. This is a very intuitive tool. I'm going to show it to you right now. So Raghav, you can share the link of this spreadsheet on the chat for everyone to see. So what you guys can do is you can make a copy of this spreadsheet on your drive or locally, and you can just play with it, right? Raghav, can you share the link right now?
Yeah, I'm sharing.
So the link will come to you in a minute. So before that, let me make you understand the basic things here. So we have this column here which states that there are 30 years left in your job. So you are 30 years of age and you retire at 60. So you are going to do a job for 30 years and you have an yearly income of 6 lakhs. So assuming an initial monthly salary of 50,000, your yearly income is going to be 6 lakhs, right? And it is going to increase year by year at a rate of 4%, let's say in this case, yearly salary hike, right? So it is increasing, as you can see. And the initial expenditure is 3,60,000, assuming that your monthly expenditure initially is 30,000, right? And that is also going to increase because why? Because of inflation that we talked about. The price of everything is increasing day by day. So the yearly expenditure is increasing. So if you subtract that, we get that the cash we save in that particular month, right? And we can use this saved up cash, we can either store it in a normal savings deposit account, or we can invest it in some in fixed deposits, or we can even invest it in stock exchanges. We're going to look into all that scenarios. So I would highly recommend you download this Excel file and upload it onto your drive, or you can even use it locally, and you can play with the data here, and you can see how this plot changes. This is the plot where we're plotting the current wealth that we have in with us over the years, right? So let's say the rate of inflation here is 7.5%, right? And first example that we're going to take is we are not investing our saved up money anywhere, so the investment return is 0%, right? And our yearly salary hike is, let's say, 10%, right? So if this is the case, as you can see, I have the this column tells you the current wealth that you are accumulating over the years, and at the end you would have accumulated around 6 crore rupees, right? Now remember, we made an assumption that we are not going to do any further investment after we retire. We are going to simply have the money that we accumulated over 30 years, and we're going to enjoy it, right? So here I've made one calculation which tells us how many years are we going to spend this money, assuming the rate of inflation rate is the same, right? So with this money we can only spend 12 years, and after that we're going to run out of money. So if I reduce the yearly salary hikes to, let's say, 8%, you can see the rate of growth of wealth reduces a bit, and now instead of 6 crore you have around only 3 crore rupees. So the accumulated money almost halves. I have reduced the salary hike by just 2%, and the accumulated wealth at the end of 30 years almost halves. And now you can spend this money over the span of around 7.5 years, right? So now let's see, what if we put this money into investment every year. So as we are saving up some cash at the end of the year, we're investing it. Let's say we're putting it into a fixed deposit which gives around 6% of return, right? So if we put 6 as the investment return, let's see what changes. See, this graph becomes more steep, right? So the current wealth increases at a greater rate, and you have around 5 crore rupees saved up, and you can use it for around 12 years. And now let's say instead of a savings deposit, we invest it in stocks. Now in stocks, what happens that if you invest your money in good quality stocks over the year into the top quality stocks of Nifty or Sensex, then you can get a good 15% return annually. So if I plug in 15 here, let's say, that means you are investing wisely over the years. So look at this. Now you have 20 crore rupees in your hand at the end of 30 years, and you can spend it over a period of 24 years, right? So now, are you guys following with me here? Anyone, can you just unmute and
Yes.
Yeah, we are following.
yeah, cool. So now let's say the next one more thing we can do is we can just make the salary hike growth of salary hike rate less than the rate of inflation. Let's say I make it 5%, and I am not doing any kind of investment. I'm making it 0%. What it does is the current wealth graph changes drastically. So after a certain point of time, you are actually losing money. So so after this particular point in time, you don't have your money starts to reduce, right? And if you take a note at this column here, right here, cash retained. So after a certain point, you see that the after 23 years, the cash retained becomes negative. So according to our rules, what it does is after the cash retained becomes negative, it takes up, let's say, 12,000 rupees. The guy is lacking 12,000 rupees in that particular year. So he'll take this money from the saved up cash from the previous year. Like he has saved up around 43 lakh rupees till now. So he'll take up this money from his emergency fund that we talked about earlier. He's going to use up this. So right. So the investment for the following year also becomes reduced, right? So in this case, we do the calculation. If we see that the current wealth starts reducing after a certain point of time, and we have saved up only around 26 lakh rupees, and that will not even sustain us for a year after retirement, right? So you can see that just reducing the salary hike by a few 1 or 2 percentage values, we have drastically changed our whole financial scenario of our life. So in the same situation, with the salary hike is less than our inflation rate, which is going to be the case mostly in most kind of jobs. Let's say we are doing some investment in a good set of stocks. and we, let's say we make it 15%, just see what change it makes. Now we're not losing money anymore, we are gaining money, and we have saved up around 9 crore rupees, 9.5 crore rupees at the end of 30 years, and we are, that can sustain us for around 16 years at the current rate of inflation, right? So with the same salary hike percentage and the same rate of inflation, the difference comes, are we making good use of our saved up money or not? If you are not investing it anywhere, then we are in deep trouble. But now if you're investing it in a good set of stocks, in a good portfolio, then we are going to get good returns, and that can actually sustain us for a long time after retirement, right? Now let's say if instead of investing in stocks, if you choose some safer options, let's say a normal savings deposit that will give you 2.53% of interest rate. So if I, let's say, do that, now look, you are losing money again. So and that will barely sustain you for 2 years. So savings account are a good option if you want a very stable return over the years, but that return is very less, and it is not at all feasible for you, right? And this is assuming that your expenditure is 30,000 and it is increasing at a rate of 7.5% of inflation rate, and which is not the ideal case. Like, your monthly expenditure is going to increase over the years, like gradually. When you grow older, medical expenses will come in, you have to spend for your kids, and then that expenditure will add up to this more. So in such a scenario, in the real world, we can see that making good investments of our saved up money is so much important for our lives. So now this is what the life calculator is about. You are always free to play with this whenever you want to, and see how investment can affect your the financial scenario of your life altogether, right? Do you have any questions? Is this part clear? You can just put a thumbs up if it is clear to you.
Yes, it's clear.
Right. If you have any questions, you can actually put up the question in the chat box. Our moderators will answer that for you. All right. Okay. Moving on. So since we have covered this life calculator, moving on. Now we know why should we invest, but where do we invest it? We have multiple options with in front of us. We have fixed income instruments, real estate, equities, derivatives, and commodities. So now we're going to look into all of them one by one in a very basic level, right? So in this slide, we see that we have first we have fixed income instruments. I'll put the laser. Right. We have fixed income instruments right here. So what does this mean? It means that the return from these investments are actually fixed and are predefined by the company, or by the government where you are investing it, right? So this includes savings account, fixed deposit, and recurrent deposits. So these services are provided by normal banks that you have out there. So savings account, where you can put deposit money and withdraw money wherever you want, and they give you very less amount of return, which I showed 2.53% or somewhere around that. And then you have fixed deposits. In fixed deposit, you submit a chunk of money, and you take up a particular fixed deposit plans. So every bank has a plethora of policies that you can take up in case of fixed deposits. So they'll tell you that I'll return you this money that you gave to me with a certain rate of interest at the end of 10 years. So that is pre-decided. So when the so now when the 10 years end, we say that this our fixed deposit has matured. You must have heard these terms, your parents are maybe speaking about it all the time. So we say that the fixed deposit has matured at the end of 10 years, and then you can take that money out. Always that you can also take your money out in between 10 years if there is some emergency. In that case, you won't get the rate of full interest as the return, right? Then you have recurring deposits. Recurring deposits is similar to fixed deposits, except you are making deposits monthly. Okay. So this also promises you a fixed rate of return, which is around 6 to 7% at the end of X number of years, but you're depositing in a regular basis. So, and then we have government and corporate bonds. So this is new to many of you, I believe. So what are these bonds? Bonds are basically a way by which government and corporate companies, they raise money from us. Just like when, let's say, I need to build a house or I need to buy a car. So if I don't have enough money for it, I can actually finance it. By financing it, what I mean is I can actually take up a loan from a bank. So they'll give me a loan, and I have to return that loan with interest over a period of, let's say, 10 years or 15 years, right? So similarly, if the government or the corporate companies, they need to raise money for some of the any of their activities, they can actually take a loan from the uh, common people like us. So this is what we call as bonds, where the government takes loan from the public. And what similar to normal loans, in bonds they also promise a fixed amount of rate of interest as return after a certain period of time, right? So this is all about fixed income instruments. Next we move on to real estate right here. So in real estate, what we do is uh, we can invest the money in lands or buildings. And how do you earn from that? Let's say we buy a land, and after let's 5 years or 6 years, the value of that land increases, right? Let's say there is a good hospital that is built up nearby, or the urban infrastructure around it develops, so the value of the land increases by a huge amount. So then if you sell that land, you actually earn a good amount of profit. So similarly for buildings, you buy a house, and you can sell it up later to another individual with at a higher price to book a profit. Or you can either buy a house and then rent it out to other people, and then you can earn a steady amount of money monthly from that, right? Last point that we have is capital appreciation. Is nothing different. This is what I talked about. You buy something, and when its value increases over time and then you sell it, you gain a profit. That is what I mean by capital appreciation, right? Next we have equities. We're going to focus on equities a lot in this session. So we need to know what equities are. Equities are basically shares of companies in the stock market. By shares, what I mean is, shares is basically when you own a share of a company, you're actually owning a part of a company. So let's say a company has 1,000 shares altogether, and I own 10 shares of that company. So that would mean that I am actually owning 1% of that company, right? So this is what I mean by equities. So we're going to talk about equities a lot throughout this session. So we'll come back to it. Next, we'll cover commodities. What are commodities? Commodities are different things like metals, let's say copper, zinc, and oil and gas, gold, silver. All these are commodities. So you can invest in these as well. How? Direct investment, by directly investing in the object itself, in the material itself. So let's say you buy a few gold biscuits, let's say, and then you store it with you, and when the price of gold increases uh, after a certain number of years, then you can sell it off and you can book a profit there. That is a direct investment. And then we have here commodity companies. What do we mean by these? The companies that deal with these things, these commodities are called commodity companies. So you invest in the shares of those companies. So we call that commodity companies, investment in commodity companies, right? And then we have ETFs. ETFs means exchange traded funds. What I mean by this is, ETF is basically a collection of stocks, not only stocks, a collection of stocks or commodities, and you can invest in them as a basket, right? So this might sound like, if you know about mutual fund. Mutual fund is also a collection of stocks, and you can invest in them all together, right? So, but the main difference between mutual fund and ETFs is that mutual funds are traded at the end of the market day only, but ETFs are traded throughout the day, like a normal stock does, like throughout the market hours from 9:30 to 3:30, right? So what difference does it make? Difference is the ETFs are more volatile than mutual funds. So if you are searching for a more secure mode of investment, mutual fund is the way to go. So these things, ETFs, they can either focus on a particular sector. So if you buy ETFs for let's say IT companies. So yet that ETF will comprise of different companies from the IT sector, and you can buy that. So they can either focus in one particular sector or one particular commodity, right? These are ETFs. Moving on, we have derivatives. This is a very high level concept which we are not going to cover in the Quant Foundations workshop, but I'll just give you a very brief idea about it. Crudely, you can say that derivatives are basically, we are basically betting on other assets, or on other assets, that whether that price will increase or decrease. These comprise of futures and options, right? So we are basically betting on whether the price will increase or decrease at a certain point of time. So let's say today the price of SBI stock is, let's say, 400 rupees, and if I buy a futures of SBI stock, then and I'm getting an agreement that the price of that stock will, let's say, become 450 after 2 months, for example. So if it actually happens, then I earn a profit. If it does not, then I earn a loss. So you can read more about it if you are interested, but we are not going to cover derivatives in Quant Foundations for now. Is this part clear? Different income investment instruments. Just put your thumbs up if it is clear to you, or if you have any questions. Cool. If you have questions, you can always. All right. Could you explain ETFs again? So ETF is basically it's a basket of different assets. What I mean by basket is I'll give you that IT sector example again. So if you buy an ETF of, let's say, IT stocks, right? So that stock basket will contain different stocks from the IT sector, right? Let's say Wipro or HCL or all these things, all the IT sector companies, right? So what it does is uh, when when generally the stocks in one particular sector move together. So when there is any good where there is any good news for the sector or the stocks do well, the stock basket of IT, the ETF of IT sector, they do well all together, right? So when you invest in ETFs, you're actually investing in a particular sector. Similarly, you can invest in ETFs of commodities. So ETFs of commodities, they focus on particular commodities like gold, silver, oil and gas, all these things. A similar concept you can find for mutual funds also, which are also basically asset baskets, right? They are actually a collection of different assets. But the only difference between ETF and a mutual fund, that I said earlier also, is that ETF is traded throughout the market hours from 9:30 in the morning to 3:30 in the afternoon. But mutual funds, they're traded only at the end of the market hour. So what this makes ETFs more volatile, right? Because they are being traded throughout the day. This is the difference between ETFs and mutual fund, but they are fundamentally the same on a basic level. Is that clear to you, Pankaj? Yeah, Pratham, we can trade government bonds as well. Like if we buy a government bond, and the government bond says that, for example, the government bond says that I'm going to give you 5% rate of interest, 5% return at the end of 6 months, right? So you are not obliged to hold that government bond to yourself for the 6 months itself. So you can actually sell that bond to someone else at the end of, let's say, 2 months. So at the end of 2 months, if the bond gains some value and you can sell it to some other person, then you get that small profit that you have got for in those 2 months. And the other person can either choose to hold that bond for up to its maturity level, or he can also trade it whenever he wants to. You can trade it just like equities. Capital appreciation is very simple. So when you are in case of real estate, let's say, so when you are, let's say, buying a land, and the value of the land increases after a certain number of years, because there have been developments in that area. The roads have been developed. There are schools and hospitals around by. So the value of the land, the intrinsic value of the land increases over the years, right? So you can sell it later at a much higher price. So that is how you gain profits through capital appreciation. All right. So moving on. Now we are done with where to invest, or there are different options among us. We are going to focus on equities. But before diving into equities, we are going to look into detail where does this originate from. To look into that, we need to look into the life of a company, starting from the company's birth up to the point where the company is listed on the stock market. We have to understand the whole process. Then we'll have a clear idea about what are these shares and what do they actually mean to us, right? So we have these different paths, these different steps. First, the birth of the company, and then we have angel investors, then we have venture capitalists, private equity investors, and then finally we have this initial public offering, which is the IPO, right? We'll discuss about them one by one. First, we have the birth of a company. So this is very simple. We have an entrepreneur. We have who has a very good business idea. In our case, let's say he's going to sell personalized shoes, right? So, but he does not have much market knowledge and he does not have much capital also to start off with. He needs some money to start off and to set up an initial supply chain and start the manufacturing process initially. He needs some money for that and he does not have it. So what does he do? And he does not have contacts as well with the other investors in the market. So he asks for help from his friends and family. So he gets some people on board among his friends who can help him with some money to just start off with the business. So this is where angel investors come in. These are the investors that make the very first investment in a company, which we call the seed investment. As you can see here, angel investors, the seed investment, we call it the very first investment made in the company. So in our example, let's say we have got 5 angel investors. 5 of his friends agree to help him and they together raise 1 crore rupees, right? So in return the friends would be expecting something, right? So in this case, this is where shares come into play. So what is this shares? So the shares is basically we give shares to those friends, and tell them that legally these shares are a proof that you own a part of the company, right? So whatever when the shares grow in value later in later in time, we'll see how it grows in value, by the way. When it grows in value, you can actually sell those shares to someone else and then you can earn profits. So let's say the company issues 1 crore shares. The company is going to have 1 crore shares and it is going to stay like this throughout the same, unless some exceptional circumstances occur, which I'll hint about later. It is going to stay the same 1 crore shares, the and since the value of it is 1 crore given by the angel investors, the value of every share is rupees 1, right? This is simple division. I think you can all do it. So this is what we call the face value, which is the price of every share at t equal to 0 of the company. So the face value of the share in our case is rupees 1, right? So you can look up the face value of any existing share. Like if you look up the face value of Reliance Industries ka share, you'll see that its face value is rupees 10. In our case, the face value of our company share is rupees 1. And now look into this particular table, right? So now who owns these 1 crore shares that they have been issued? Not all of it is owned by the promoter and angel investors. By the way, promoter is the one who owns the company, like the entrepreneur in our case, the company originally belonged to him, right? So he is the promoter here. And then you have angel investors. So not all of the shares are owned by both of them. Uh, so let's say 30 lakh shares are owned by the promoter and 20 lakh shares are owned by the angel investor. So they together make up 50 lakh shares, and in total we have 1 crore shares, right? So how to explain this? We have 1 crore shares issued and 50 lakh shares allotted, and the remaining 50 lakh shares have been issued but not allotted yet. So they will be allotted gradually when the other investors come on board, right? So 30% of the company, 30% of the total shares are allotted to the promoter and 20% allotted to the angel investors, right? Now we have 1 crore invested in the company, and remember the face value of the share at this point is rupees 1, right? Next comes in venture capitalist. So the angel investors helped him start up with the company, all well and good, and now he wants to build some other manufacturing units in some neighboring cities, let's say. So he needs some more capital, and he can't raise this capital through friends and family alone. He needs to bring in some other investors who can provide him a good chunk of money, and we call these people venture capitalists. And so now the first funding that we get from venture capitalists is called the Series A funding. So we can bring in multiple rounds of investment from venture capitalists, and we'll call them series A, series B, series C funding, and so on, right? It can be as many as the company needs. So we have series A funding in our case, and the promoter and the venture capitalists, they negotiate and they agree for 5 crores for 10 lakh shares. So now you might ask, why did the venture capitalists agree to buy 10 lakh shares for 5 crores? That is 50 rupees for every share. The original value was 1 rupees, right? So why did the VCs agree to buy the shares for 50 rupees? Are they dumb? No, they're not. Why did this happen? Because the company has actually grown in size. It actually has a customer base right now, and they're actually earning profits. So the intrinsic value of the shares, the intrinsic value of uh, being a owner of that company has increased. That's why they have seen potential in the company. That's why they have agreed to buy the shares for 50 rupees. So they got, let's say, 10 lakh shares, and they invested 5 crore rupees into the company, right? So now look into this table. So the promoter owned 30 lakh shares, angel investors own 20 lakh shares, as we saw earlier. Now the VC Series A funding, through that the venture capitalists they got 10 lakh shares, right? So now we have 60 lakh shares allotted, and remaining 40 lakh shares. Remember we issued 1 crore shares in total, right? So we have more 40 lakh shares which is issued but not yet allotted to anybody, right? There is one more change happening through this VC funding. This is very interesting. So the VC people they bought the shares for 50 rupees and the angel investors did it for 1 rupees. So now the shares are priced at 50 rupees. So now uh, think about the profit of the angel investors, right? They first bought it for 1 rupees and now those shares have value of 50 rupees. Now if they want to sell it to someone else they can sell it for 50 rupees and they'll gain much more profit, right? But the angel investors generally don't do it at this stage. They generally wait for the IPO to dilute their shares into the market, because that is when you will get maximum profits from your shares. Okay. The value owned by the angel investors has also increased. Now let's say the promoter decides to bring in another round of VC investment, and we call it VC Series B investment. And now the company has grown even larger, and it has covered multiple states in the country. And the Series B funding, they bought 10 lakh shares for 10 crore rupees. So now the shares are priced at 100 rupees per share. The share price is almost doubled. So the angel investors have made their investments 100 times, and the Series A investors has made their investment almost double, right? So this is what happens. Now we let's say the company needs a large amount of investment. They want to go overseas, they want to open manufacturing units, and they want to sell their products in other countries as well. So they need a very large amount of investment, and it cannot be provided by venture capitalists alone. This is where private equity investors come in. Private equity investors, these people are very rich, they have a lot of money, and they have like the and they not only invest money into the companies, they also provide people who can actually get onto the board of directors of the company, and they can actually steer the company into the right direction so that their investment in the company is worth it. So let's see in our case, the private equity investors, I'll call them PE investors, they give 50 crore rupees to the company for 20 lakh shares, right? So here, what is the price of every share? It is 250 rupees. So the price of every share is 250 rupees here. So they buy 20 lakh shares more. Now, if you look into this table here, the other things remain the same. We just add private equity investment, which is Series C, and the 20 lakh shares are allotted to them, right? And now since every share is cost 250 rupees, and there are 1 crore shares in total, the company valuation is 250 crores, right? Now note here that uh, 10 lakh shares are there out there which have been issued, and they have not yet been allotted to anyone, right? This is where IPO comes in, where the company is listed on the stock market, and the common people like you and me, we can go and buy those remaining 10% of the shares, trade those 10% of the shares, and invest in the company, right? So now we're going to discuss about IPO. Till now, is there any question from the listeners? Do you have any questions, guys? If it is clear to you, you can just put a thumbs up in the meeting. Okay, how is VC different from private equity investor? So right, so both of them are investing money, but the thing is, private equity investors invest money in a much larger amount than the VC. If you notice in my example, the VCs invested 5 to 10 crore rupees, but the private equity investor invested on 50 crore rupees, right? They invest a larger amount of money. Plus, the main difference is that the private equity investor not only gives money to the company, they also give qualified personnel, so that who can mentor the promoter, and they can see whether the company is heading towards the right direction. Because since they are giving a large amount of money, they want to ensure that their investment is worth it, right? They don't want to lose that. So that is why they provide people, qualified people to the company who can drive them towards the right direction. That is how that is how private equity investor is different from VC. How the shares till now, before IPO comes in picture, is spectated. You can't spectate as in, I think what you want to ask is, if a company has not yet not yet been listed on the stock market, you want to know who is owning how much in the company, right? Is that a question, Bhanu? uh, if that is the question, you actually can't spectate the price of the stock share in the company on a regular basis. If it is not on the if it is not listed on the stock exchange, you can't do it unless you have some contacts. Yes. So since PE investors, as I said, they are putting at stake a lot of capital. So they generally don't come in on board initially. They come in at a very later stage of the company where the company has matured a lot and it has a good enough market presence and a good customer base, and it has a good enough business model such that the PE investors think that it has good upside potential. If they are assured of that, only they can invest in the only they can invest only then they invest in the company. Can we see the company's balance sheet? Yeah, I think you will be shown the company's balance sheet on the fundamental analysis day. So I think on day 3 we are doing fundamental analysis. We are going to discuss about balance sheet on that day. Can you give some examples of P investors from India? Yeah, right. So there are many P investors from India, right? So let's say you must have heard about Parag Parikh, right? These are different big P investors in India. Parag Parikh is one of the big P investor, and banks also invest in them, right?
I had a question.
Yeah.
Why will they buy at 50? Like you answered it, but I still have this doubt that like
Mhm.
even if the company is performing good, okay, why don't I buy at let's say one rupee and expect it to rise because it's gonna rise if it's doing good? Why will I buy it? Why I myself will buy at 50?
You will buy at 50 because the promoter will not sell it to you for rupees 1, because he needs the capital to grow the company, right? Even let's say the venture capitalists, they see potential in the company, but if you don't provide it the capital to grow, how will it justify that potential? I'm making myself clear. The
Yeah, yeah,
promoter will make demand
got it.
for some money, and it needs that money to make some growth. And if the VC does not allow it, then the promoter will not accept the offer simply.
Yes.
Right. So now we'll move on. We'll go into details about IPO. This is a very interesting topic. Recently, many good IPOs came up, Paytm and LIC. You must have heard it was all around the news. So we'll see what the IPO is exactly and how the process takes place. IPO stands for Initial Public Offering. So this is where the company decides to get listed on the stock exchange and make its shares available for the general public to trade. Right. So in our example, the remaining 10% of the shares, which was yet unallotted, they decided to put it up on the stock exchange so that the general public can trade the shares. But why? Why can't we just pick up another venture capitalist or pick up another PE investor and sell those 10% shares? It serves IPO serves multiple purposes. One of them is ESOPs. What is ESOPs? Employee stock options. Employee stock options means the employees in the company, they will get a benefit when they're appointed. They'll get a benefit. They can own a certain number of shares in that company, and they can sell it off whenever they want to. This is employee stock options. So many big companies like Google, Microsoft, they provide employee stock options, and you will get across this term in 4 years from now when you sit on placements, and when you're in interview, they'll tell you about ESOPs. Okay, so you need to understand these concepts well. Right. And then we have exit option for existing investors. So the investors who had invested in the company for a long period of time since when it began, they might want to book profits now, because the value of the shares that I'm telling you, it was 1, it became 250 now. But where is the money? They'll get them. It is only on paper, right? They'll get the money only if they exit. They only if they sell the shares, right? So a few investors might want to sell off their shares and book profits. This is one thing that IPO provides. The last thing that we have is company visibility. So when the stock gets listed in stock market, people trade on it every day. People talk about it. It comes on news. It comes on finance news channels. People talk about it. The visibility of the company increases. So in a way, it acts as marketing for the company. So in this way also, getting listed on stock market helps a company grow its customer base and make more profits and grow further, right? Moving on, we'll now look into more details into how does a company exactly enlist itself in the stock? What is the process behind it, right? How does it happen? Is anyone saying something?
So I had a question
Yeah.
that can't the company offer employee stock options before the IPO has been launched?
No, because the employee is not employee is just a general normal citizen, right? They cannot do it. Cool. So now we're going to look into details about how does actually IPO happen? What is the process involved? So the first point that you note here is appointment of a merchant banker or book running lead manager. So applying for an IPO is a very time-taking process and a lot of technical things are involved. So they appoint someone who has a good financial background, who can take care of this process. We call them merchant bankers or book running lead managers, BRLMs. Right. So these people, they prepare the financial reports, they prepare the offer reports, and they apply it on SEBI. What is SEBI? SEBI is the Securities and Exchange Board of India. So they look after everything starting from the IPO process, trading of stock in the stock market. SEBI looks after all of this and make sure that everything is going on according to the government norms. So these merchant bankers, they help the company apply to SEBI for an IPO. When the SEBI gives the initial approval, this is not the final approval. SEBI gives the initial approval, then the company starts preparing something called a draft red herring prospectus. What DRHP? So what is this DRHP? This is a very big document which that the company needs to make before getting listed in the stock market, and it is made publicly available, so anyone can see it. So what does this document have? This document has information about the company, and it tells us why does it need an IPO, who is in the management position, what are their backgrounds, and about the different financial and legal information about the company. And the people, the normal citizens of India, they can go through the DRHP document of any company who is going to have an IPO, and they can decide whether they want to invest their money or not. This has all this information. So in fact, right now I'm going to show you the DRHP document of LIC. If you, in fact, you can get the DRHP document of any company that you want, just a Google search away. So the first link here itself is the DRHP document of LIC. So if you know that LIC recently had its IPO in the beginning of May, and its DRHP document was released on February 13th, as you can see here. By the way, this is the SEBI's website, Securities and Exchange Board of India, SEBI's website. So it has the DRHP documents of all companies in history. I'll just show that to you quickly. So see, so these companies, let's say they have some Uniparts India, Plaza Wares. They have also uploaded their DRHP documents on SEBI's website. They are going to have IPOs later, right? All these companies. There are many pages you can see. So I'll show you the DRHP document of LIC. Yeah. Okay. I'll just zoom in a bit. Yeah, so on the top right, you can see it is written draft red herring prospectus, dated Feb 13, right? So it is the DRHP document of LIC, and see this particular line here under this listing heading. I don't know if you can see or not. Yeah, the equity shares offered through the red herring prospectus are proposed to be listed on the stock exchanges, being BSE and NSE. So I think this is clear to every one of you. BSE and NSE are Bombay Stock Exchange and National Stock Exchange. I'm going to talk about what is the stock exchange in a few more slides. Don't worry about that. So it clearly says that the red herring prospectus proposes that this company is going to list its stocks on the stock exchange. Next up, look at this. Book running lead managers. Sounds familiar, right? We just talked about this. So these are the list of the people, the merchant bankers who have helped the company apply for the IPO. and they are not independent individuals. They actually belong to a company. They're employees of a company. So let's say this Ganesh Rane, he's an employee of Kotak Mahindra Capital. Similarly, all these names are very familiar to you: Goldman Sachs, JP Financial, JM Financial, JP Morgan, Nomura. So these have provided one employee and who act as book running lead managers for the IPO of LIC, right? So now if we look into the contents, okay. So this is a general content respective. In the introduction, what we have the offer. What is LIC offering actually? So this section, it will list down how many shares is being listed on the stock market, what is the what is the price bracket, etc. Right? And then we have these things, summary of financial information about the company, some general information, capital structure. So it has the different financial aspects related to the company for the public to go through. About the corporation, I told you that this DRHP document, it shows you information about the company. So what is this industry overview? Industry overview means it gives you details about the GDP. It talks about the GDP of India, and it talks about how this particular sector is doing, the sector that LIC belongs to. It talks about the business model of LIC and how it earns money, right? It talks about the policies of the company. It talks about its history. It talks about its management, promoter. The promoter is the one who owns the company, right? So now a quick question for you. Let's see who can answer first. Without Googling, of course, who is the promoter of LIC? Quickly, any one of you.
Government of India.
Can you be more specific?
President of India.
Exactly. The president of India is the promoter of LIC. So I'll just show it to you if I click on this. So just read up this paragraph. Our promoter is the president of India because LIC is a government company acting through the Ministry of Finance, GOI, right? Our promoter currently owns 100% of the pre-offer paid up equity share capital of our corporation. So pre-offer paid up equity share capital of a corporation. So this is before listing of IPO, of course. He's owning 100%, and now a part of it is going to be listed on the stock market. So after offering the shares on stock market, so the promoter shall hold something percent of the post offer paid up equity share. So this, how much percent is the promoter going to own after listing, is blacked out. Why? This is confidential information. Since this document was listed on February 13, so on that date, this information was not yet made public, right? So this was made public far later. What percentage of the share is going to be listed, and what percent will stay with the promoter. So as of February 13, this was confidential, right? So this was the promoter, and they talk about their management also here. So there are many people here. See the names and their positions. They are the managements. So all the information can be found out in the DRHP prospectus. Let's look through the other parts of the contents page. What all is there? Then we talked about. All right. Then financial information. This is again a deep report about the financial statements of the previous years and about the whole market capitalization and all those things. Right. And this has a bunch of legal information. And this section 7 offer information has a greater detail about what the offer consists of, what the IPO offer consists of, and all the details about it. Right. So, and it ends with description of equity shares and main provisions, insurance of main provisions of LIC Act, embedded value report, other information, declaration, all these things. So this is basically, if I say in Hindi, this is the complete kundli of the company. That the general public can see and decide whether they want to invest in this IPO or not, right? So you can simply search for the DRHP document of any company. You can just give it a Google search, DRHP, then company name, it will come up, right? Now moving on. Right. So this is about the draft red herring prospectus. Now we'll talk about the listing. How does listing happen? So before listing, the merchant bankers, they come up with a price band that the people like normal citizens, they have to apply in the IPO, and they have to say They have to bid for prices. By bidding, what I mean is they have to say that, okay, I want to buy this many lots of shares in this much amount of money. I have to make a bid, right? And that bid must be within a certain range, and that range is called the price bracket. And this price bracket is decided by the merchant bankers. I'll repeat it again. So I have to make a bid. If I want this IPO share, I have to make a bid. What I mean by bid is I have to tell my broker that I need to apply, I need to buy this many shares at this price point. And that price point must lie within a certain price bracket. And who decides this price bracket? The merchant bankers. The merchant bankers work closely with the company and they look into the demand of the company's IPO among the general public, and they decide what price bracket should be good enough, right? So I make bids. Where do I make bids? 3-4 days, 3-4 days before the listing day. Listing day is when the company actually appears on the stock market. Okay, before that it does not appear on the stock market, but you can apply for it and you can make bids there, right? What happens on the listing days? The price point at which the company has received maximum number of bids, that is the price at which the company is listed on the stock market, right? The price point at which the company has received maximum number of bids, that is the price at which the company starts being getting traded on the stock market on the listing day. Cool. So after that particular point, we call it the secondary market, where me and you can normally trade on the stock, right? Even if I have not applied for the IPO in the primary market, after listing day, I can trade, I can buy and sell those stocks. This is IPO. Any questions in the chat? If it's clear to you, just put your.
Yeah, I had a question. Like,
Sure.
who all are the people who can bid? I mean, are they individuals? Are they firms? Or who are these people
We
who
can
bid before the list?
normal people can bid in the company, like you and me. We can go and bid.
And that is done through the stock exchange?
Yeah, like it happens before listing. It will not appear on the stock exchange like as a company, but you can apply it. Like there is a different option for IPO application. You can go there and apply.
I just want to ask, like, it is only totally based on luck, like if we get the share or not in primary market if the IPO is listed.
Typically it's purely luck, but in case of LIC there were a few rules made that people who had LIC policies will get more preference, and then the employees of LIC will get some more preference. Some kinds of rules were there, but other than that it's just pure luck. Yeah.
Yeah, I also had a question.
Yeah, Vedant.
Yeah, so while pricing the IPO, is demand the only factor, or the book value or what company actually holds is also accountable?
Can you repeat? I couldn't follow completely.
Yeah, I was asking, while pricing the IPO, is demand, what is the value of the company in public perception the only criteria, or the book value of the company is also taken into account as well?
Yeah, both are taken into account. Not only the demand, but also not all the financial aspects of the company are taken into account before deciding the price bracket of the IPO. How much profit is it making? How much debt is it in? What is what is the customer base? What is the potential of growth in customers over the years? All these things matter before deciding the price. Right. Cool. Now,
I have another doubt that I am still confused in what is bid exactly.
bid is exactly it's like an auction house, like where have you seen how an auction house occurs? So there's an object if you want to buy, and the people in the audience, they just raise their placards and they shout out prices that they want to buy at that price. That is called bids, right? Have you seen it on movies or something? Right, they just tell that I want to buy it at this price. That is what I call making a bid, right? So in the primary market, before the listing day, 3-4 days before the listing day, the common people, they can place bids in the IPO application. So what happens in an IPO is the in the primary market is the shares are sold in lots. You cannot simply buy one or two shares. You have to buy in lots. In LIC's IPO, I think it was 12 or 15. I'm not very sure. So you have to buy in lots in multiples of those lots, right? So and you make a bid in the price bracket of that IPO that I want to buy the share in this particular price point within the price bracket. And if a particular price receives the maximum number of bids from the market, from the common people, that is the opening price for the listing day. Is it somewhat clear, Vedant?
Yeah.
So the bids can be made only within the price bracket that has already been fixed by the company.
Yep.
Right?
Yep. Right. Exactly.
Who all decides the minimum price for the bid?
The merchant bankers.
What exactly it is, like the merchant bankers?
So the merchant bankers are the people who which the company has appointed. Like before, before getting the company has to make an application to SEBI, who is the regulatory board of everything. They have to apply to SEBI that I want to make an IPO. Okay, so that application process involves submitting a lot of documents, different reports to SEBI, and everything. This process is supervised and maintained by the merchant bankers, the book running lead managers. So these book running lead managers, they also decide the price bracket for the company, the minimum and the maximum price.
Okay, got it.
There is also something called a cutoff price. So what a cutoff price is that the price at which the bid price is, let's say, from 100 to 300, and then the IPO opens at 200. So now we call it the cutoff price. That is one just jargon that I wanted to put out there. All right. So now we are done with the IPO.
Excuse me. Can you also repeat what is listing day again?
Listing day is the day when the IPO actually appears on the stock exchange. I'll actually show you all these things. Hold on. I'm showing in case of LIC only. These are cool. Yeah. Look at this. This is the LIC IPO date. May 4 to May 9. This is actually the pre-market time. So this within this time, can you see the website? Everyone can see the website, right?
Yeah.
Yeah. So from May 4 to May 9, this is the pre-market, primary market, primary market, where the people can place the bids, right? This is the face value of the share, 10 rupees. I'm sure you remember what is the face value. It is the initial value of the share when the company was first started operating. And this is the price bracket, 902 to 949. Cool. And then we have IPO lot size. This is the thing I talked about. So if you are applying during the primary market during this period of time, you can buy shares only in multiples of 15. You cannot just buy one or two shares. You can buy only in multiples of 15, right? This is this thing. And about the listing date. So the listing date is, yeah, you can see here. Listing date is May 17. Right. There is two other things here. Initialization of funds and credit to Demat. These two are important things. I'll tell you what Demat is, then you'll be able to understand what this means. The listing date is the date when the company actually starts operating on the stock market. So it is May 17th, right? So if I show you the graph of LIC here, if I go to max, let's say I go to 1 month here. Yeah, I'm in the first data point. Look at the date here at the bottom. What does it say? May 17th. Is that right? 875.25 INR, Tuesday, 17th May. So all charts of LIC everywhere will start from May 17. That is the day from which everyone can trade that share on the stock market.
So, like, how can be price lower than 902 as it's the lower limit for listing in stock exchange?
Yeah, so there have been many memes about it. So actually, like, people have bid, but I mean, the people have make bids within that price bracket, but there have been a lot less demand than expected, and so the opening price was like there was a lot of discount given in the opening price itself, and it was brought down. So there have been a lot of memes about it that LIC is given discounts to investors as well. So this is a very exceptional event, and it does not generally happen. If I show you another IPO, let's say I show you. Um, Wait. So I'll explain this once more. So what this happens is that uh, they have bid within this price bracket 902 to 949. Okay. So let's say the maximum bids that happened was at, let's say, 920 rupees, right? So let's say I applied for the IPO and it got approved. So I now own the shares on 900 at 920 rupees, and I get those shares in my Demat account in on May 16, right? But since there was a lot less demand in the market for the share of this LIC, the market actually opened at 849. So I would have incurred a loss on the listing date since I bought the shares at 920 and now the IPO has opened at 823. So I would have incurred a loss on that. So this is how it happens. So like the people who get the IPO, they get it at a share, they get it a price within the price bracket, but it's again a matter of demand and supply when it comes to deciding the price on the listing day. So it might also be the case that the opening price on the listing day is a lot higher than the price bracket itself because the demand was so high. So immediately when the market started, a lot of people started placing orders for it. There was a lot of demand in the market. The price shot up within a few seconds. That actually happened in case of Nika. You can look it up. So in Nika, the opening price of Nika was a lot higher than the price bracket because there was a lot of demand for it. Am I somewhat clear here?
So it is not guaranteed whether I'll be receiving the shares even if I place the bid, right?
No, if like, see, I'll tell it again. Let's say you have placed a bid at 920 and you get accepted, like you are approved, right? So you get those shares at 920 rupees only on May 16th. May 16th, the IPO has not yet been listed on the stock market. So on 16th, you get your shares in your account at 920 rupees. But when the market opens at on May 17th, right? And if the demand is too low, and people are selling off their shares in panic, and then the stock actually opens, the first trade that happens at a lot lower price, which is 823. So you would have made a loss in that case, and many people did in this case. Right. So if your bid gets accepted, you get that share before the listing day in your account, and on the listing day, the first trade that happens on the market, it decides the opening price of that day. So if there is a lot of hype about the stock, yeah, the first trade on that listing day will be a lot higher and you will book a profit. And but in this case, it was even lower in the price brackets. It was 823. It was 800. How much? 875. So you'd have people have booked a lot who got the IPO approved. Am I
Yeah,
clear here?
Pradeep, I think we can move forward.
All right. Cool.
Everyone, we
So
will have a Q&A session at the end of the presentation. You can ask your doubts onto there.
and also if you get any doubts in between, just post it in the chat. Our other moderators will answer them in the chat as well. Now, moving on, we'll look into some stock market jargons, which you should definitely know before making investments. So first up comes the stock exchange. We have two main stock exchanges in our country, the BSE and the NSE. BSE stands for Bombay Stock Exchange and NSE is the National Stock Exchange. So, and there are other smaller stock exchanges as well, but they are actually dying out and not very relevant. These two are the main two stock exchanges. What is the stock exchange? This is basically a marketplace where you can buy and sell shares. You can basically think of it as a mall where you go there and you can buy and sell shares from different companies, right? This is a marketplace, stock exchange. They actually do the order matching. Like I am placing a order that I want to buy a share at this point, and someone else wants to sell the same share at that same price point. So BSE and NSE, what they do is they find those two individuals and they match them and they execute that order, right? So this is what the stock exchange does. And next we have stock market participants. So these are the people who invest in the stock market. We have domestic retail investors who are people like you and me, who are Indians residing inside India who invest in the Indian stock exchanges. We are domestic retail investors, right? Next up, I'll put up the laser. Next up, we have foreign institutional investors. These are the foreign corporates and companies who invest in companies inside India. They are called FIIs, foreign institutional investors. Next, domestic institutional investors. They are the domestic companies who invest in stocks. And we have NRIs, non-resident Indians who are outside India. They're investing in the Indian market. They're NRIs. And you have asset management companies. They manage mutual funds and all these things. They pull a lot of money from different individuals and they put up in different efficient portfolios, pre-decided portfolios, and these are asset management companies, right? Next, we have the broker. So we cannot directly go to the stock to BSE and NSE and tell them that I want to buy this stock. So I have to tell my broker. What is a broker? The broker is the intermediary who actually talks with BSE and NSE and places your orders on behalf of you. So broker examples of brokers are on your right: Zerodha, Upstock, Sharekhan, Access Securities, Grow, all these things. You have seen ads about this on TV all the time. So these are the brokers. So you make an account with the broker called the trading account. You place your orders there and broker goes and tells the stock exchange that this is the order. The stock exchange does the matching of the orders. They find a person who wants to sell the stock, then they match the order and then they execute it, right? So broker is the intermediary between you and the stock exchange. Next up, we have the Demat account. Oh, I'm sorry. I think I missed. Yeah, Demat account and trading account. So what is this? So the account that you make with the broker is called the trading account. That is where you do your trades. Now, once you have shares, once you own shares, the shares are stored inside the Demat account, right? Demat stands for dematerialization. I'll tell you why in a moment. So Demat account is the account where the shares are stored, right? And these accounts are managed by someone by a thing called depository. So Demat account belongs to these depositories, and the trading account belongs to the broker. I mean, belongs to you, but you can have to do it with you have to make that account with the broker, and these two accounts are interlinked with each other, right? So these two depositories are like banks for the stocks where you can store your banks for shares where you can store your shares in these Demat accounts. So we have two main depositories in our country: NSDL and CDSL, National Securities Depository Limited and Central Depository Services Limited. These two depositories are the main two one, and your Demat accounts are stored in either of them. You cannot actually choose between which depository you want. They don't have any difference. The broker actually just chooses one for you and stores your stocks there. So and about dematerialization, what dematerialization is? So before 1996, all the trades that happened were on physical paper, right? So the share certificates were issued in physical paper. It was a very time taking and a very inefficient process, right? After 1996, SEBI declared that it is compulsory for everyone to digitalize their share certificates and digitalize all the transactions. And this whole transition was referred to as dematerialization, right? So from that point on, the share accounts came to be known as Demat accounts, right? So I will repeat again shortly. The Demat account is the account where you store your shares. And trading account is the account that you make with the broker through which you can do the transactions. Depository manages these Demat accounts. Next, we talked about SEBI already, Securities and Exchange Board of India. This is like like the regulatory body. It is a government of India body. It manages all that. It sees that the stock exchange, the brokers, the retail investors like you and me, and all the other companies who are investing, they are doing everything fairly, and everything is happening according to the government norms. So SEBI takes care of all of these. SEBI also takes care of IPOs, as we saw earlier. So that's what SAVE is. So I think that's all from my side. Now we'll move on to how to actually read the stock market charts and how to place orders. Raghav will take over from now. Thank you.
Is my screen visible to everyone?
Yes, Raghav.
Yes.
Yeah, okay. So now we know that what happens behind like a stock market and how the companies are listed and like how what all people are involved. So now we'll be looking at like the actual stock market charts and we'll try to trade amongst us. So this is what a stock market exchange chart looks like for a company. This is for FTSE. Right now, European markets are open, so we'll be trading live in that. So this is a normal line which tells us about the market price trend of the company, and we can just analyze how the price has been moving for a long time. So each dot in this line represents a day of the year, and we cannot. I mean, we cannot extract much value from it, but this tells us about the trend, how the price was moving. So this is not what usually traders use, and like for investors as well, when they try to analyze the company, this line chart is not what usually they see. What they see is this candlestick chart, which looks something like this. We will start with the candlesticks only. So what is a candlestick? A candlestick is basically like the data point which represented a day, but that day consisted of millions of trades and millions of price fluctuation that happened in that day. So a candlestick basically provides an overview of what happened during the day. So a candlestick is named as such because it consists of a thick part, which is known as the body, and the wick part, which is where the price moves. So let's assume yeah. So let's assume that this was the price trend that followed in the day. So the lowest point which the price hits is represented as the low of the candlestick, and the highest point it hits as is known as the high of the candlestick. These are the opposite ends of the candle, and the price at which the market opens, like the first trade of the day for the company, is listed as the open price, and similarly, the last price of the day is listed as the closing price. Now, these candlesticks come in two colors, green or red. So, if the opening price, that is the first trade price, is lower than the closing price, that is our company gained value in the market during that day. So the candle appears to be green, and similarly, if the company lost its value in the day, the candlestick appears to be red. So the second part in a stock market chart is the order book. So most of you must be wondering like how a price of a stock is decided. I mean, what is that which fluctuates the price of the market during the day? So it's an order book. An order book usually consists of the sellers and the buyers of the stock. So this is what a typical order book looks like. The numbers in red are representing the sellers, and the numbers in green are representing the buyers. So, like, if you're a seller of a stock, you want to sell it for the highest price possible, and like, if you're a buyer, you want to buy it at the lowest price. So, what they do is they enlist their price, they bid and ask offers, and the order book arranges them in an increasing and decreasing order, respectively. So, as you can see, the buyers have been arranged in a decreasing order, and the sellers have been arranged in an increasing order. And this, the middle part, where they come to a conclusion and the trade happens. So if the ask price matches the bid price, or a buyer decides to buy at the ask price, that is when the trade happens and the price gets updated. You can see how the red and the green prices are being updated. That is how. So, and now this on the center is a depth chart of the order book. Here, the height of any point this represents the volume. That is how many trades, how many stocks are available at each price point, and this price is listed as such. So as you can see, like most of the buyers want to buy at a very lower price, and the most of the sellers want to buy at a very higher price. So their volumes are higher, and the people who come to a negotiation are very less. So this in the between is where the trade happens and the price gets updated. So moving on to placing orders. Is anyone having any doubts until here? Uh, you can put it up in the chat box, or yes, you can. Cool. Put a thumbs up if you have understood this, and we'll be moving forward with placing orders. Yeah. Okay. So yeah, moving on to placing orders. So when we place an order, we basically we need to learn about four things before placing an order. First is position. So, do you want to buy the buy the stock so that it will grow or it will lose? I mean, are you predicting that if the price will go up, then you put a long order in which you decide that the price is going to go up, so I'll buy this some of the stock and then sell it at a much higher price. Similarly, when you think that the price of the stock is going to go down, so you short, you basically sell the stock and then buy at a much lower price, resulting you in a profit. So, and the second is take profit and stop loss. So with the position, you enter the market, you want to long or you want to short. But then for exiting, you can either exit at a market price, like you go into the portal one day and decide that this, like I'll take out my money from this stock right now and just take it out at the market value, or you can put a take profit or a stop loss. So what take profit does is you can specify a price that like at 1.85% of the profit. Sorry, at 185 price, the share should sell automatically. So when you specify this price, whenever the stock after buying reaches this point in price where it crosses the take profit limit, it sells automatically. So it by that you can make a profit. Similarly, there is stop loss. So if you think that you cannot handle a loss more than a certain amount, you specify a stop loss price, and the trade will occur whenever the price goes below the stop limit. Stop limit. Next up, we have limit order. So a limit order is basically like since we can exit a trade at whichever price we want, we can put a stop loss or a take profit. Similarly, we can buy also at a specific point of price. So what we can do is we can put a buy limit, and we can specify that I want to buy at say 32,000 rupees, 32,444 rupees, and whenever the price trend crosses this buy limit, we will buy the stock will automatically be invested in your account, and this is how you can specify a price and then like go away from the portal, and the price will be the stock will be traded automatically. The order will be executed. Now, next up, we come to bracket order. So, whatever the three things, the limit order, take profit, and the long short, if we combine them into one order, if you want all of these, so that results us in a bracket order. So, bracket order has all of the things. We can either short or long. We can also put up a take profit and a stop loss, and then also we can put up a limit order that we want to buy at one point in time, one point at one particular price, and then sell it at a particular price. So yeah, so this we will try to place a bracket order in this account right now. So each of you can comment if you want to long or short the price of this particular stock, and we will see at the end of the Q&A session that if our account made a profit or a loss. Okay. So I think the majority of the people are saying for a long, but so yeah, okay. Majority of the people are going for a long price. So we will try to place an order. So this chart which I'm using is of a company by TradingView. So you can all access the TradingView platform. You can Google it up and just open the price. We are doing it at FTSE 100, which is a European market. It is owned by London Stock Exchange. And Pradipta, will you put a link up of TradingView platform of this stock, FTSE 100? Yeah. Hmm. So we will put up a buy in order. So what I have opened right now is a paper trading account, and in which this is the basically paper money. You all can try at the end of the session. You can open a paper trading account in TradingView. You can trade the stocks at. I mean, you're basically using fake money, and you're trying to predict if the stock will make profit or will go long or short, and you can make profits and losses, and it won't affect your real money. So yeah, this is how you can test your strategy or how you judge the sentiment. So we will try to place a limit bracket order. So let's say we want to specify, we want to buy at 7580, and we will go for a buy, that is long position, and we will take profit at, no, let's go to the day-to-day market. So candlesticks also come in various sizes. Here you can specify which candlestick. Oh, sorry, yeah. Huh. Here you can specify which kind of candlestick you want. I'm using right now 1 minute candle because yeah. So we will buy at, this is a very 187. Yeah. Oh, no, that's fine. We will buy at 85. We will sell at, let's say, 91, and let's put a stop loss of 75. So now I'll place the order. So as you can see, there is a buy limit, there is a take profit order. All three of the quantities are specified, and our stock is currently here. So whenever it crosses this limit, it will buy a stock, and if it crosses after that, after buying, if it crosses the above line, it will take a profit, or if it crosses the lower line, it will book a loss. So if that's it for today. Please make sure to join on the day 2 and day 3. We'll be covering technical analysis and fundamental analysis of stock market. And after you've done all the 3 days, we will be having an introduction to the projects which will make up the rest of the summer of Quant. These projects are going to help you in building your CV as well as your Quant profile. So now is the Q&A session. You can all ask questions. Go on, like unmute yourself and ask questions, or put up your queries in the chat.
This is not going to be, the workshop is not a selection criteria for fresher selection, but I would highly recommend the freshers to go through the sessions of the Quant Foundations workshop at least, if you want to have a good chances in the selection. It could be of a great help to you.
So, with Sharma, yeah, what is a limit order? Could you explain again? So, yeah, so limit order is basically like we have placed it right now. So the price is very close to the buy limit right now. So this thing where we put a limit on the price, that whenever the price crosses a certain point, it will buy. It will automatically buy, or like depending on whether you've chosen long or short. Let's say you've chosen long. So whenever this price of the stock crosses this buy limit, it will automatically buy the price at the price you have specified in the buy limit. Is it clear?
Yeah, it's clear. Thank you.
Suppose. Yeah, guys. Anyone who found this interesting should you must go to the TradingView platform and try to use paper money to buy and sell the stocks. It'll be a fun experience where you can visualize the stock market exchange. Yeah, Shivam, I just gave a tour of that, and there are multiple YouTube videos which would explain in a more concise manner. But yeah, I'll definitely go through. Once you make a account on the TradingView platform and then you enable paper trading, this is something you can see in the YouTube videos. And after that, you can just search for any stock. Just like go to this bar, symbol search, and then search for any stock. Like right now, Apple must be closed. Yeah. For example, I've opened the Apple stock exchange and this Apple stocks, and this is closed for the day. Similarly, you can search for any other market, any other company, and then trade on it. I think we're about to done.
Okay, so we have a couple of questions. So about algorithmic trading, we are going to teach it in the Quant masterclass. So if you are very much interested in that, you can actually enroll for the strategies topic of the Quant masterclass. There we're going to cover algorithmic trading and about derivative and how it's different from equity. So derivatives, as I said earlier, also derivatives are basically options and futures. So basically, if I speak in a very crude level, you are betting on different assets whether they will. You are not betting on the price effectively. You are betting on whether the price will increase or decrease. So that is what derivative is. So derivative in its literal sense is change, right? So you are betting on how the price will change. That is what a derivative is. And about algorithm trading, quant masterclass strategist topic, just enroll, you can study about it.
Like the foreign nationals are allowed investments in the Indian markets, are the Indians also allowed investments in the foreign markets?
Yeah, we can.
And I mean, what are those stock exchanges called? I mean, through what medium can the Indians invest in markets in like USA?
Let's say in USA there are stocks like Nasdaq or NYSE. NYSE is the New York Stock Exchange, right? You have the London Stock Exchange. You have all these things in different countries. You can invest in them. They have completely different stock exchanges, completely different set of stocks. Even you will find the same company stocks in different countries stock exchanges. So like that, you can invest in there.
And do the rules of trading, I mean, vary according to who is investing? Like for foreign nationals, are there different set of rules? And for the domestic nationals, are there some rules which are different?
About this, the basic rules are same for everyone as given by SEBI, but I'm not sure there might be some different rules for FIIs for institutional investors than retail investors. I think yes, there are. The institutional investors and the retail investors have a few different rules in terms of, let's say, how much tax or how much they have to give. These kind of rules are different for them.
All right. Thank you.
Yeah, so guys, we have entered the market at the price which is specified. And let's see if the price goes up and we will take a profit, or it goes down and we book a loss.
All right, guys. This trade will take some time to finish, I think. So we'll update you guys about how this trade ended in the channel. You can keep an eye on that for it, on how your trade performed. So now I think we'll stop the recording and we'll end the session. Thank you everyone for joining. So just a reminder, we have the next session on fundamental analysis. Session on technical analysis tomorrow. So the